Joining us right now to talk markets is Sarat Sethi. He is portfolio manager at DCLA. He's also a CNBC contributor. And Sarat, the biggest story that's been driving the markets is what's happening with AI, what's happening with NVIDIA, what's happening beyond that. This morning, there's a story in the Wall Street Journal that says the economy is now addicted to AI spending. And in fact, if that spending were to change, it could take down the broader economy with it.
Yeah, I mean, you're looking at all the spending that is happening in data centers and power and chips, and that's really driving this K-shaped economy. And then you see Meta come in yesterday. You know, stock was down 20% after they announced a huge CapEx. So what do? Let's go to Google and see if we can get some substitution and now have some purchasing power. So it's very interesting to see how this is all playing out. Now, at the end of the day, I think they all win. And you can see Google's now the star. I mean, a year ago or 6 months ago, it was OpenAI. Google was out. So I think you got to play in these areas, but you just have to be careful that you don't put all your eggs in one basket and be diversified, because these are hyperscalers are positive cash flow and growing. The question is, where do the margins go down in the future? Because it's going to get really competitive.
Yeah, at this point, we are in this deal frenzy, though, where every one of them is trying to do deals with the others to guarantee that there's not just one winner, that there's not just one monopolistic player that they have to deal with.
Right, and if you can look at kind of the circularity in the deals that NVIDIA has done with Oracle, and now is Meta going to be partnering with Google. They're kind of all
AMD is in the mix, and Intel's in the mix, and everybody's kind of helping each other out.
So it's all the expenditure. To your point, the economy is dependent on it. So how do we get the rest of the economy? How do we get the rest of the market? The generals are leading, but where are the soldiers going to be? Are the generals going to come back, or do we need the soldiers to catch up? And I think that's where the opportunity is. Yeah. It's great to own these companies. They've done really well, but a lot of it's already been embedded in the price. So we're looking at sectors like healthcare. Like you take, for example, a J&J. They're going to grow double digits for the next 5 years. They're getting rid of their ortho products. Pharma's doing well. Robotics, vision. The stock trades at 17 times earnings. You look at, other companies like Morgan Stanley that's got wealth management going double digits. And then just look at the basic economy. Like the dogs of the Dow, these are companies that haven't gone anywhere, like Air Products, that's down 20% for the year, or, other companies in that area. So I think there's plenty of opportunity. I mean, even in travel, Delta's flat for the year. And now, given what's going on, the premiumization of flights being full, that's where you're going to make money. So I do think there's money to be made. The question is, not to just keep on chasing the same ones that have done the last 5 years.
If you don't chase those big AI companies, though, you're saying you're not recommending people have no exposure.
No, be diversified.
Yeah,
absolutely. I mean, look, our top holdings NVIDIA and Google. So, but be diversified in the sense that, hey, you can take profits if they get too large, but also look at other areas, because that's kind of where I think, as the economy moves forward and rates cut down, you want to be in other exposures. Mm-hmm. So I think exposure to other sectors is really important. They've been crowded out just by the AI trade.
Ray Dalio was here last week, and he talked about how he would be saving cash. He didn't mean the dollar necessarily. Right. He was looking at treasuries and other ways to do that. But he might be holding on to some cash or cash equivalents in order to be able to play when and if there's a bigger downturn.
Look, and we get those opportunities every 12 to 18 months. Liberation Day was one when the markets kind of came back. You might see that, depending on what happens next year with the economy, where Fed cuts go. I mean, look at what just happened as soon as you hint of a Fed cut. So there's opportunities in the overall market and the opportunities in specific stocks. And I think that's been shadowed out or crowded out again by these big stocks. So you'll get another pullback at some point, whether it's a geopolitical, it's a dollar decision, and that's kind of when you go. But I don't think anyone's saying get out of the market. It's just making sure that your exposure to certain areas is not too high, especially if you haven't really looked at your portfolio in a while.
What do you make of the market's volatility recently? What do you think that signals?
Well, I think you had some breakage in the system, especially with leverage and credit. So we don't know exactly where that happened, but you saw Bitcoin came down. That's decoupled, and that's a good thing, because you didn't want all assets to correlate together.
Right.
So, and then I think the credit markets, definitely people are looking below to see where are we going to see some dislocation. And I think we haven't seen that yet, just because it's been so diversified over there. So it'll be interesting to see where the alternative managers come out of this and who's carrying it. I mean, is it in pension funds? Is it insurance companies? We don't know. So I think, and if we get through it, then the markets could rebound. But I think that was a little bit of the canary in the coal mine, and you kind of have to be careful. So I think to that point, Ray Dalio has always been cautious. But I'm an optimist. I think the markets will do well in the next couple of years. It's not going to be the straight ride we had from Liberation Day. It's going to be bumpy going into year end and in the first quarter.